Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris Rapeseed, Winnipeg Canola, and Malaysian palm oil.
Hello and welcome. Before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of the patterns, levels, analysis or any related items on these, my charts. This was all my own original work, as I think you deserve to have that. So with that, Paris Rapeseed. Since the low in mid-March, where we saw the fall ending with a hammer pattern, we've seen a V bottom and then overall prices for the most part very gradually moving higher in what I initially thought might be a possible ascending triangle pattern, which became an ascending wedge pattern. The lower trend line for both is the bright red mid-March to date uptrend, currently at 478 3/4. And initially I chose not to draw a new trend line on the top side, but instead rely on two previously highlighted features. The first is the fairly flatlining and now rising gold long moving average, which is, well, was rising, it's not rising that much now, currently at 497.5, and or the dark blue neckline extension, currently 496 3/4 to the April to August 2024 head and shoulders top. Now, we had attempts higher over both of these over most of mid-May, but we finally had a really concerted attempt higher 5 weeks ago. Though this initially looked good, a gapping changeover move lower put the market back down within the body of the ascending wedge pattern again. The fall was slowed by the bright green, very shallow neckline extension, currently at 481 even, and that's of the August to September 2024 head and shoulders top. A neckline that has acted as a resistance in April and a sort of support at the change from May into June. We also had support from the mauve medium moving average, currently at 482 even, and I suppose also the green short medium moving average, currently 486 3/4, plus the congestion area between the bright green neckline extension and the 50% Fibonacci line of the May 23 to January 25 move at 467 1/4. So overall, we are once again in the immediate future supported by this congestion zone below and capped again by the gold long moving average above. Nevertheless, 2 weeks ago I decided to lay out some potential targets topside for this ascending wedge pattern, though, as I said last week, and I quote, I freely admit I have doubts about them and would consider that some immediate retirement should prices drop down below the congestion zone below, end of quote. So primary target X is up in the 521 even area, just above the congestion overhead between 514 to 519.5 that capped prices 4 weeks ago, plus a secondary harder to reach target X1 up in the 537 area. This one looks very hard to achieve until you realize that we have limited overhead congestion past the congestion between 514 to 519.5 that capped the rise 2 weeks ago. Beyond that, well, it looks quite clear right now, but first we have to get up there, and that is something the market did not manage to do last or this week. Prices have instead started to test the downside, closing below the bright red lower trend line of the ascending wedge pattern for the first time last week. It looked a bit too early for downside targets, but bearing in mind the topside targets are already out there, which now seem very, very moot, I last week risked laying out some targets below to balance the upside. Thus, a primary target X2 is down at 462 even, underneath the 50% Fibonacci line of the May 23 to January 25 move at 467 1/4, but just above the late April low at 461 even. We also have a secondary harder to reach, much harder to reach target X3 down at 433.5, a target that seems very out of reach right now. Winnipeg Canola. Back in mid-May, we started to run into some serious overhead dynamic resistances. Specifically, a resistance I mentioned 11 weeks ago, and I quote, some generated congestion roughly between 723.70 to 735.20, plus a recent ascending wedge lower trendline extension, end of quote. Now, I also added to this list 9 weeks ago the neckline extension highlighted, that's now in bright red on my daily chart, of the old August to October 24 reverse head and shoulders continuation pattern. It's currently at 757.90. This one has been particularly good at capping the market as recently as 4 weeks ago and at the start of 3 weeks ago. The only reason I didn't mention this any earlier was I thought back then that the 723.70 to 735.20 zone congestion area overhead would have been enough. In the end, we had a gapping changeover lower 9 weeks ago, leading to what was initially tempered on approach to the overhead 50% Fibonacci line of the July 23 to September 24 move at 700.5 before finally breaking higher mid-June and filling in the changeover gap. All this was achieved from the ammunition gathered in the earlier drop down as we entered June, down to the previous mid-May low in the 664.10 zone, which is coincident with the November 24 high and the interesting 38.2% Fibonacci line at 665.70 of the same July 23 to September 24 move that the 50% Fibonacci line above had capped prices on, plus the not insignificant rising green short medium moving average currently at 701 even. So all these halted the decline at the turn from May to June. Now, as I said 5 weeks ago at the end of my commentary, and I quote, "So what have we growing here as a pattern?" Well, I'm not too sure, but if I was to hazard a very really outside idea, then I would look at the action recently as a possible bearish cat's ears pattern, or less outrageously, maybe a double bottom, end of quote. Well, since then we have seen the formation of the easier double bottom pattern. This followed on higher to reach both the primary and secondary targets, but then 4 weeks ago the market became capped once again by the previously mentioned bright red neckline, dropping back down in a stepping motion down to below the green short medium moving average, as well as the 50% Fibonacci line at 700.30, back to levels we saw in early June, just above the lesser Fibonacci line at 678.40 and a little above the mauve medium moving average, currently at 671.30. This has left us all somewhat rudderless with a possible topping action, but no definitive pattern emerging as yet. We might still have to form some other pattern, such as a head and shoulders top, and I'll watch out for that, but for now I don't see any major pattern as yet. And for those who ask, no, I am not comfortable drawing fresh bullish Andrews or shift pitchforks just yet, as it looks like unstable ground right now. Bursa Malaysia, crude palm oil. There are some market features that have helped hold up the market, but some of which have now given way, and others that have been tested and seen good supports right now. To start with, I'd look to the wide congestion area now overhead between 44.08 to 45.59. This is a bit far away, but I just wish to remind you of it, as this was a support that is now resistance, a longer term resistance. Next, there is the significant combination of the 38.2% Fibonacci line of the May 20 to March 23 move and the 50% Fibonacci line of the May 23 to December 24 move, both closer at 42.74, being joined recently and now separating away by the declining medium moving average, currently 41.98, which interestingly capped prices late last week and the start of this week and is being tested once again today. Nearby we have the lesser Fibonacci line just above at 42.39. On all these, I said 13 weeks ago, and I quote, "It seems that some significant bearish pressure is meeting some quite substantial bullish supports. Something has got to give, and for now is looking like the downside might. If it does, then apart from the July 23 high at 41.89, we might not have anything of note below until the congestion starting at 40.26. Caution." And that was the end of my quote. Well, 13 weeks ago we gapped lower and dropped down through that 40.26 zone, briefly trying to become an elastic move back up, trying to fill in the gap left behind, but failing to do so, and making another smaller gap lower 11 weeks ago, pushing down to and through the interesting dark blue neckline extension, currently at 38.73, the small late May to April 2024 reverse head and shoulders bottom. I had said 11 weeks ago about this dark blue neckline, and I quote, "This is one to watch on the downside, as it is the core of a large April to September 2024 congestion zone, stretching roughly from 3750 up to 4100. End of quote. I also added at the same time back then, and I quote, and since, "These actions have brought to my mind another new pattern that may be just about completing, but which can even now still be derailed. It's a look at the whole move down from the high back in early December 2024 to date. It's a really big halfway hesitation pattern. To give an idea of the potential on the downside, we have a possible target X down at 3750, right on the far end of the congestion we sit within right now." End of quote. Well, 9 weeks ago, we reached down and achieved the target at 3750, even overshot it a bit. But we've had since then a strong and extended reactionary move back up, such that the dark blue neckline extension, which became a key support, resistance, and now a congestion point, all at the same time. Importantly, we have since also started to try and move higher with what turned out to be, as I said 5 weeks ago, and I quote, "a possible, if imperfect, bright red ascending triangle pattern formed over May to date." It's a small pattern. I could regard the action over yesterday and the day before, as an attempted false break on the downside that so far has failed. False breaks, coming as they do so far along the triangle and so close to the tip, are not unexpected. And whilst I cannot as yet give definitive targets for either side, I can give an idea of the potentials involved. Thus, a true confirmed break higher over the bright red upper trend line will have a primary potential of plus 209 ringgits, with a secondary harder to reach potential of plus 298 ringgits, whilst a true confirmed break lower below the bright red lower trend line will have a primary potential of minus 131 ringgits, with a secondary harder to reach potential of minus 298 ringgits. And that's the end of the quote. Since then, we've stabilized over the bright red upper trend line, leading with the earlier numbers to a primary target X topside in the 4190 area, and a secondary harder to achieve target X1 up in the 4279 area. In many ways, these two areas encapsulate the area of congestion seen overhead. Last week, the market reached up and opened over target X, capped as it was by the mauve medium moving average. And I'm now looking at the secondary target X1 higher up at 4279 as the next potential. There is one other feature which I would like to discuss, and this came about because I was at the end of June speaking about it at a presentation at the Biofuels International Conference and Expo in Brussels, Belgium. It was and is to watch out for a key level from now until the end of this year, and that level is 35.99. If we push down below 35.99 before the end of this year, then we would have set up the conditions here in palm oil to make that rarest of patterns an annual key reversal, with all the implications such a huge longer term pattern may bring. Please watch out for this, as it is important, and I will bring you more details should we get down below there, even though I know we today are many hundreds of ringgits above it. Just bear in mind we still have many months of this year to go.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.